Matt, welcome to the show. Glad you could be here.
Thanks for having me, Dan. Good to see you again.
Yeah, Matt, I wish you weren't so darn smart. You guys figured out that your Substack is worth money and you put it behind a paywall. I was enjoying that.
Yeah, well, we still try to put a good amount out for free, at least a couple posts a
That's
month.
right. Yeah, I'm just funning you because it is great stuff. It really is. Um, I I
Appreciate it.
would normally with an investor like you, I would normally say, "Hey, you're new to the show. Let's see. Let me just ask you, what kind of investor are you?" But anybody who wants to know the answer to that question just needs to go to your website, eaglepointcap.com, and it says in big bold type, "We are long-term business owners." So you buy stocks for clients and hold them for ever?
Not necessarily forever, but we do try to hold them for a long period of time. We think that's an advantage, as our mindset is to be business owners. So I think in the stock market, people can get wrapped up thinking about stocks as squiggly lines on a screen or pieces of paper for trading, when in reality, you're a minority partner in a real operating business. And we think it's helpful to take a real ownership mentality of those businesses, just like you would if you owned a partial stake in, I don't know, a local business like a local car wash or something that was private. You wouldn't really be reacting to every Fed meeting or, you know, jobs report,
Right.
thinking you need to get in or out of that business. And so we think that ownership mentality is useful, and that means you're going to own these things for very long periods of time.
So I'm going to press you though on the long term because for some reason that's what captured me when I looked at this. Because that's when you think about it, it's really hard, isn't it? It's hard for people to hang on to businesses while the quote is staring them in the face every day. And it could be up, down 50%. I mean, how many on its way to becoming a what is it, 2000 bagger or something, Amazon was like down 35 or 50% like multiple times. Um, that is that's just plain hard. So I, I guess I don't even know if there's a question in there. I just know that like folks get scared when stocks are down and they don't, even if they know it's a great business, maybe they just don't know it enough because how they behave at the bottom of like a bear market, right? They just sell everything because they're tired of the pain. What's there has to be some kind of secret. Is the secret to long term just knowing the business cold? Because we assume Buffett wants to hold forever, right? Warren Buffett wants to hold forever, and we know he knows more about that business than any other investor, right? So is that the secret? Matt just knows so much that he can hold. Is that it?
I think that's one angle of it. So one thing we really focus on is simplicity. So we are not the smartest people in the world. We're not Warren Buffett. So we try to own really simple businesses that are easy to understand. As minority stockholders, we will never know as much as an insider, but to the extent that we can, keep the big idea in front of us with these businesses. So I'll give you an example. We like businesses that have very simple unit economics, and those are typically going to be royalty type businesses or businesses that can grow, let's say, a store count. So let's say you're a McDonald's or a Wendy's. So you're going to grow your same store sales at each restaurant. You're going to build some new restaurants, and that's going to contribute to your royalty, and then those royalties can typically be paid out as dividends and buybacks. And so you can pretty easily, back of the envelope, figure out what your forward returns might be in terms of your growth rate plus your yield. And then, of course, you're a stock investor, so there's going to be a change up or down in that multiple. But we really focus on the business component. If you were if you own the whole business, you'd really be focused on that growth rate plus the yield. And so we think putting that front and center in these really simple businesses that we're able to understand, uh, gives us an advantage, gives us some holding power. And then, of course, we diversify so that hopefully not all of our businesses are going down at the same time. Part of that element of simplicity is tending to prefer businesses that are non-cyclical. So businesses that don't have a ton of operating leverage or things like that. they're just easier to value through a cycle. I love the auto dealers, but you have to do a lot of normalization to understand, where they're trading now versus normalized things versus a company like DaVita Dialysis has pretty stable, revenues and earnings through the cycle.
And yet Davita has certainly had seen its share price fluctuate quite wildly over the years. That's a perfect example of what I'm talking about. Like, we know where the money's coming from, and we know that the people literally can't live without this thing, you know, and yet, you know, it fluctuates as much as anything. I mean, it seems a little crazy, doesn't it?
Oh, absolutely. I mean, DaVita's had a wild ride with, I don't know, 35% plus drawdowns in the last couple of
Yeah.
years. And yeah, it's extremely stable. And that's also the advantage, right? So if we were actually going out and buying entire private businesses, nobody would sell us DaVita Dialysis at 6 or 7 times free cash flow, which is where it traded for a couple months last year. Because in a negotiated transaction, the other party would be well informed and know that it's worth substantially more than
Right.
that. In the stock market, we can take advantage of that volatility. So when we understand a simple business and see a bargain, then we can go get a deal. And that's sort of that piece of the stock's return is there's the business component, but plus or minus the multiple. So we try to find a margin of safety in a low multiple.
Yeah, Matt, you bring up the multiple, and one of the things I saw on your website, Eagle Point Capital, I love it. He said, "We aim to buy all investments for less than half of our conservative estimate of intrinsic value in 5 years." I mean, I love that. It's very specific. It almost reads like a mission statement. Like
Yeah.
it's very easy to
Yep.
use that as a framework, I suppose, for a starting point for everything, right?
Yeah, absolutely. So we think of kind of intrinsic value and forward returns sort of as like a still image versus a movie. So intrinsic value is kind of a good snapshot, and then forward returns are kind of the movie. So as it's moving along, so a lot of what we do is trying to figure out unit economics, kind of like I walked through with like Wendy's. So we'll try to find that growth rate, and that growth rate plus the yield plus or minus a change in multiple, and that kind of gets us to a 5 year forward return. And then if we can buy that forward return, when it's sort of a mid-teens to 20%, we start to think that's pretty attractive. And so we think of growth rate as, what is the company, how much capital are they going to retain, and what's their incremental return on that retained capital? That gets us to kind of a normalized growth rate. We'll, check that with kind of what management's saying and what we think they can do. And then a big component typically for us is going to be that yield. So how much then of the capital that they're not retaining, are they going to give that back to shareholders through dividends, through buybacks? And yield's kind of nice because it has that built-in component of a multiple, a valuation multiple. So, the stock's got to be trading at a reasonable value in order to get a reasonably high yield. And then we look for that to be typically in a sort of at least low to mid-teens rate. That is kind of our business return. And then we want a margin of safety with the multiple. So we do look for margin or multiple expansion to kind of kick those returns up over a 5 year period.
Do you view multiples as a proxy for, like, the discounted cash flow analysis?
Yeah, so I mean, I think we try to be not overly, specific about multiples, but generally, like you want a low multiple, right? Like that is always going to increase forward returns or at least decrease risk,
Hmm.
right? The kind of the price you pay, if it's lower, always increases the margin of safety. So we don't try to do a big like Excel spreadsheet with a DCF and decide that it's 8.1 times present value. But we sort of know if you can buy something for 10 times or less free cash flow, good things tend to
Right.
happen. If we really focus on cash, right? If the cash is really coming into the business and management is, doing intelligent things with that cash, either reinvesting it intelligently or giving it back to shareholders, then that, at least in sort of like the medium term, tends to give a lot of support to a stock. There's just not too many good businesses that are going to yield more than 10% dividend yields, for
Yeah,
instance, for long periods of
that
time.
idea you just said, and I meant to actually talk about this earlier because you mentioned it. This idea of uh, how much capital they're going to reinvest at what rate. Like, if I could point to one thing I learned from Warren Buffett that just sailed over everything else, it would be that. Because that's when it hits you. That's why these things are compounding machines. So you need to look for the highest
Hmm.
rate. And, you know, after starting out in the, traditional way of looking for cigar butts and whatever, and finding them actually in like 2002, was a good time for that. But, then making the typical sort of evolution onto finding great businesses, that one thing, the idea of free cash flow or owner earnings, as Buffett calls it, his version of it, whatever it is, that's really important. But that idea of finding a business that reinvests a certain amount at a certain rate, there's not a million of them out there, are there? I mean, this is not something like a great business makes so much money, tends to, that it can't reinvest it all, right? They literally make more money than they know what to do with. Um, yeah.
Absolutely. Yeah, that's the issue is that good investment opportunities, high return investment opportunities are typically in short supply, even for the best businesses. And I like a company like AutoZone is pretty interesting,
Mm,
where they
yeah.
have a long runway, right? They've been building stores for a long time, and then those stores have growing same store sales, but they are still only reinvesting, sort of a small fraction of their total operating cash flow into expansion because they are running out of places to put new stores that can be productive. And so what they've done then is taken a lot of that cash flow and basically dollar cost averaged into their shares, repurchasing them. And so I think their 10-year sales growth is on the order of 6%, but their earnings per share growth is on the order of 17% because they've been able to take their share count down so much. So we think that yield is a good way to, supplement when growth opportunities start to, run dry.
Yeah. Hence, Buffett's other obsession, like companies that buy back shares in bulk. Uh,
Yeah.
I'm just getting a lot of this from your website. You guys emphasize moats, and I feel like that's one of the other things we learned from Buffett over the years. And it was a real, like, when you find these moats, I was like, oh, that's great. That's great. You just find this moat and you leave it and you hold it forever, and that's great. And then, of course, Walmart was like the biggest retailer and the lowest prices and all this stuff. And then Amazon comes along and things change. Moats can change. Oh, damn it. So you really are looking for, instead of a moat, like a sustainable competitive advantage. Again, they're not growing on trees, are they?
No, absolutely not. So yeah, we look for what we call demonstrated and enduring competitive
Mm.
advantages. So one of the things an idea we really like, we call it replication mode. So when we're looking for a business, we want to find a really good business in the past. So they've sort of proven these unit economics. They've proven they have a moat. There's something we can go say, oh, they had really good results, and it's because of this moat. And then we can look into the future and say, well, it seems pretty likely that this is going to be persistent and that the future is going to look like the past. And if the past was pretty good, then it means the future looks good. Typically, we're able to buy only because there's some short term headwind or bobble or something in there. So we're willing to give them the benefit of the doubt of some return to the average, but we're not trying to pick major inflection points where a bad business will suddenly become a good one. I think there's a lot of money to be made in that, but that's just that's a different skill set and a different constitution required for that. Um, and so then once we own a business or when we're analyzing it, we try to ask what is the moat widening or narrowing? Because I think that there's lots of wide moat businesses out there that are
Narrowing.
narrowing and they're becoming less good. So you kind of want to look at that second derivative and say, is this a moat that is growing over time? So like, a network effect or something like that. As you plug more people in, that will start to or continue to grow and become harder and harder to surmount. Costco could be a good example where they have so much purchasing power, and then they pass that purchasing power on to the customers with limited markups, which drives a better value proposition. They get more sales, which gives them more purchasing power to bargain with suppliers. And so it's sort of a, you know, uh, self-reinforcing, moat. So we kind of look for elements like that. At the minimum, we want it to be stable, but the best businesses are going to have, growing value propositions for their clients.
What do you think about brands as moats?
Yeah, I think they can be good moats. I think that, it sort of depends. One example I always like is like if you think of consumer electronics like Toshiba. So everybody's heard of Toshiba, but it doesn't necessarily mean that brand awareness gives them a moat,
Right.
because that consumer electronics are an incredibly uh, competitive area. So I think it's important not to confuse brand awareness and acceptance with giving them pricing
Right. The
power. I think
Kleenex
pricing
phenomenon,
power
right?
is
Yeah.
all. Yeah, yeah, exactly. So I think some of the luxury brands in particular, like Ferrari, almost everyone's heard of
Yeah.
it. They can raise their prices, many times over every
Yep.
year, and demand only seems to go up.
Yep.
Or a company like Rolex or something. These are things that everyone's heard of, even if they don't own them. They're aspirational. Um, and those brands, they just have to be very well cared for. Like Buffett owns See's Candy. I think that's a good example where they've been able to raise prices, almost 10% a year for probably 40 years in a row, and people keep buying it.
Yeah. We don't go to the mall nearly as frequently as we did 10 years ago, but there's a See's Candy that's still in the mall. All these stores are closed, and we have one mall here in Southern Oregon, and all these stores are closed, but that thing is still going strong. and every time you walk in
Yeah,
there or near it, you're like, oh, I like those and those and those and those, and it's just it's a great brand actually. um,
absolutely.
and it's a big success story of his too, right? They spent 32 million on it, I think, and they've gotten I know it's well over a billion. Has it reached 2 billion out of it at this point? He keeps citing that number.
It's probably getting
Yeah,
close.
yeah,
Yeah, yeah.
it's just amazing. So yeah, I feel like brands are another one where, um, like even great ones like, I guess the best example recently might be Budweiser. They had that little they had that little episode, and they were already under attack by the craft beers, right? And then they
Right.
had this, this Dylan guy, I forget his last name, and that whole sort of Bud Light fiasco that dethroned the beer as it wasn't, the sales plummeted, and it wasn't, I don't know if it's recovered yet, but I'm like, wow. um
Yeah,
you
no, Modelo's still Modelo took over as number
Yeah,
one. I would have never imagined that
Yeah.
that would have happened, as recently as it did. But yeah, it did.
we've been
So
recommending Constellation brands for a while in our newsletter, so not disappointed, but
Yeah.
hopefully, Modelo as a Mexican brand, I don't, they're pretty conservative, so I don't think we got anything to worry about there. But it just struck me that, um, a brand is a story to a certain extent, especially in the case of a beer that doesn't taste that great. And when you stop telling the story, or when the story gets heavily disrupted, I think Jaguar has come out with this new commercial that may be disrupting the image of a
Yeah, I
man
just saw
owning a
that.
Jag. It's just it's brands are. Put it this way, I don't even know if there's a question here, Matt. I just think brands are an interesting topic for long-term investors. Just maybe I don't know if we leave it at that.
Yeah, yeah, absolutely. No, I agree. I mean, I think they can certainly be a little more fickle than other things. One sort of moat that we like is often, anything sort of rooted in the physical world where you have sort of, maybe a scale advantage. So we tend to like distributors. And I would even classify something like an AutoZone, basically model it more as a
Hmm.
distributor. than a retailer, or like a McKesson or something like
Oh
that,
yeah.
where there's a lot of infrastructure that is out there in the world that exists that in theory, sure, I mean, someone else could come build warehouses and all that, but in practice, it's impossible to replicate it overnight. And to replicate it even over many decades would be difficult, not to mention you'd then have to steal the customer relationships and stuff. So I think when you have scale advantages and you're a low cost distributor with this physical infrastructure that, for all practical purposes, is not going to be replicated, you sleep a little better at night than if you are at the whims of like a marketing agency or something that has some crazy idea for your brand that then, you know, even if you hit 9 times out of 10, if you miss once, it can be, devastating, like some of these brands you mentioned are finding
Yeah,
out.
physical infrastructure. When you say that, that's hard to replicate, especially nowadays, the way people are about land near big cities. Copart comes readily to mind.
Hmm. Yep.
Basically junkyards, I guess I'd just call it that. Um,
Yeah,
yeah,
absolutely.
you can't buy that land basically. That and they own it. Like the
Yeah.
other companies in their field don't own it all, but they own it, which is awesome. It's a,
Yeah, their competitor tried to grow faster by leasing the land, which, was an interesting trade-off, but doesn't seem to be, paying dividends. Copart sort of stuck with the long-term
yeah.
steady strategy, which I
Now,
like.
Copart was interesting because the first time I ever heard it was at the Grants conference, like Grants Interest Rate Observer conference for our listeners. Uh, I don't know, years and years ago. It could be 10 years already. It could be a long time. And because I haven't been to that conference in several years. And Grant was pressing him on it. He's like, this thing's 25 times earnings. And it's one of those things that, you mentioned earlier. It's, you don't normally get a chance to buy these things cheap, but it certainly has proven itself quite well. I guess maybe is the lesson here like you can't buy everything. Warren Buffett says you can't kiss all the girls. Um, but you tell me, have you ever bought anything like that that you knew it was a fantastic business and it was 25 times earnings and you just thought this is great, it's fantastic, we'll be okay.
I don't think so. I'd have to kind of think for a minute, but I think that yeah, we try to be pretty valuation disciplined, and that, I won't say we buy everything for 10 times or less, but increasingly we do, because you're absolutely right. You don't need to buy everything. We run a pretty concentrated portfolio, so we're typically looking at 10
Mm,
positions plus or minus
wow.
one. And that's because there aren't that many good opportunities. I think if it was a free lunch and we could buy 20 or 50 things that we understood well that were going to return 15 to 20% per year, we'd be happy to do it, but we just don't live in that kind of world. So yeah, like I would say one investor that we have learned a lot from is Bill Ackman, and he also likes simple, predictable, profitable businesses. Emphasizing royalties. He is willing to pay typically 20 to 25 times, and he's got a pretty good track record. So he's proven that he can do it, and there is money to be made. Looking for those super, super high quality businesses that are worth more than 25 times. He is finding a margin of safety in those. Um, I think that's hard to do. I mean, it's hard to do for me. I think it's easier to buy really good businesses, for 10 times. And they do seem to become available if you're looking for them, once or twice a year. Um, I would say that something like Copart, it trades at that multiple because it's able to grow faster. And so our businesses typically are going to be little bit slower growers, more of an auto zone, sort of a mid-single digit growth, but it's going to be steady and persistent. And then there's going to be a bigger component of yield there to make up the difference. So Copart is going to have a lower component of yield and a higher component of growth. I think if you look at the base rates over time, there's relatively few businesses that can sustain like a double digit growth rate in sales for, more than 5 or 10 years,
Right.
right? They certainly do exist, but they're very hard to find ahead of that fact. And typically, once they're sort of well into their 5 or 10 year run of really good sales, well, that might be a sign. Are they really going to do it for another 5 or 10 years? Maybe they will, maybe they won't. But I think we tend to be pretty conservative about forecasting well above average growth rates. So that kind of roots us in lower multiples.
I was going to say, Matt, you seem like disciplined in your approach, which is great for all investors to understand. And you're talking to two guys who appreciate like long-term value investing. I'm just curious how you got interested in it, attracted to it in the first place, and then because there's a lot of different ways you can go about putting money to work. How did you get attracted to long-term investing to start with, and how important is it to have clients that are understanding all of what you're talking about to us right now? Because it's not. I imagine it's not easy to convince certain people of this strategy and the ability to stay so disciplined.
Yeah, absolutely. Well, I'll answer your second question first. I mean, I think I always say like an investment manager can only be as patient as his clients allow him to be. So I think that having really good clients that think very long term and are patient and look through the quarter to quarter noise is a huge competitive advantage. That's, it's almost the only competitive advantage an investment management shop can have, because it's the base that everything else rests upon. And that's one reason we write our Substack and that kind of thing is just, I'm not sure I would say we ever convince people, but you try to attract like-minded people. I think Buffett and other value investors have kind of said value investing is like an inoculation. It either you kind of hear about it and it almost either resonates instantly and sticks or it doesn't.
Right.
And so we're looking for those types of people. A lot of our clients have been business owners that have exited their business, and so we find that they have the right mentality as former owners and operators to kind of proceed with that strategy. But my evolution towards value investing, it reminds me of the Jerry Seinfeld joke where he says, why when you lose something and you find it, it's always in the last place you look. Well, because you don't keep looking after you found it. I did the same thing. I looked everywhere until I found value investing, and then I was inoculated. So yeah, I got really interested in markets early on, high school and college, and I was studying engineering and was, kind of using some of the math I was learning to play around with, first it was foreign exchange markets and then futures. And then I really got into options because, they're very quantitative. And I ended up working at some quantitative, options trading shops in Chicago where I live. And that was really my, introduction to markets and all of that. And it was great to learn and see it all, but it's a really tough market. There's Citadel's hiring new PhDs every day, and we were very small shops competing with them. And I thought, even if you have a quantitative strategy that works, it's going to decay over time. Like you need to keep tweaking it and finding the next best thing. And so I thought, well, it'd be great to find something more sustainable, more sort of like tried and true that's not going to ever go away. And that sort of, just try to keep reading everything. And eventually, read Buffett and Munger and Dieter Lynch and, all the others. And it became clear that value investing has worked for a very long time. And it makes perfect sense to me that it should keep working for a very long time because, yeah, if you own something that has a lot of cash flow and returns that cash flow to you, then, there's only it can only go down so far, right? If like it hypothetically had a 10% dividend yield, well, that's well covered and going to continue. It's probably not going to go to a 50% dividend yield, so you can start to think of these businesses as having some sort of floor that would be attractive to buy them. You can't necessarily say the same thing about like Bitcoin or something.
Right. Or any commodity.
Certainly not.
That's right. That's true.
Yeah, that's fascinating. From quantitative options trading to long-term value investing.
Yeah.
But I can see that. I obviously I can see that because when you're talking about how you're describing having to keep up with all of the innovations in quant trading and there's a lot of you need to. That's basically technology. You're trying to stay ahead of technology, and which is a whole nother challenge on its own. And so, yeah,
absolutely. Yeah. And I kind of, I realized there was a way to sort of go old school and just go back to the good old fashioned reading 10Ks and 10Qs. I was sort of in this technology environment, and I remember someone was telling me how they were writing AI like 10 years ago to read the 10Ks for them, and I thought, well, it seems like it's taking you so long to write this code. Maybe it'd be faster just to read them
That's right.
yourself. And and the reading of them in the short term, yes, it's tedious. It could take a long time, but that knowledge really compounds.
Absolutely.
And you look at someone like Buffett, who's
Ab-
let his knowledge compound for how many decades.
mhm.
So that's kind of my goal, right? Is just to just keep
Yeah.
reading and build up my mental map of the world that
Right.
way.
Slow and steady wins that race, whereas the other thing in quant is like an arms race, and the fight, the war is always on. It's and you're in this arms race.
Absolutely.
Uh, I want to go back to something you said. You said that you're conservative about forecasting growth. And it struck me that that's probably that being conservative and just frankly admitting that you can't predict the future in the first place. But also admitting that you have to be conservative about projecting growth. I thought, well, isn't that one of the keys to I'm trying to get at this long-term thing, you know, because value, we talk about value a lot on this show. We've had a lot of value investors on. You're the second one in a week that we've interviewed. Um, so, but the long-termness is different because let's face it, Matt, like if you just look backwards 20 years and threw darts 20 years ago, you're rich today. So that long-termness, like that is really important. And I very much, one of the reasons why I really want to have you on is because that's you have it. You have that quote by Buffett about 5, 10, 20 years on your website. I mean, I know that's what you're about. And the holding the business mentality, that's, it's so important because let's face it, nobody really knows. Even Buffett doesn't really know how to sell. Like nobody knows how to sell. Nobody knows how to trade. The people who trade are right like 40% of the time, the great ones, right? And they're constantly cutting losses.
Mhm.
But you're not doing that. What you're doing plays into what I blithely, have told people. You get rich in the stock market by holding great businesses and just not selling them. And you've honed right in on that. You're like, this is right up my alley, and I think it's really important for our listeners to get how you are, how and why and by what mechanism really you're long term oriented. Not forecasting the growth too aggressively is important. Is there anything else that comes readily to mind when I say, you know, what's important about looking out 5, 10, 20 years besides not over forecasting growth?
Yeah, well, I think there's a couple ideas in there you triggered in me. So one is like, about the growth, it's base rates. So we try to be knowledgeable of, what are the realistic distributions of, what's the average company going to grow or something.
Mm,
And the fact of the matter is very few companies will grow rapidly. And so you need to be aware that anytime you're paying a high growthy multiple, sort of the odds are against you. Yes, maybe if you're a great analyst, you're going to pick the one that's going to defy the numbers, but you need to be very careful about that. So we try to have humility and understand that, if we're making a bunch of bets, we're unlikely to be picking a lot of stocks that are going to be able to sustain high growth rates. Um, Second is, why is it important to think long term? I think it's sort of like the law of large numbers. It's the same way casinos make money, which is like in any given roll of the die, it's pretty random. But over time, a casino knows that they're going to make money off of you if you keep rolling those dice or betting on red or whatever it is. And so it's the same for us, where we know that if a business has good returns, they're going to show through over the long term, but on any given day, it's a coin flip as to whether that stock's going to go up or down. So if you look at any great business, like look at Berkshire Hathaway, and you can chart its stock price versus its book value per share, which is a good back of the envelope proxy for its intrinsic value. Yes, in any given year, they can diverge, and certainly any different day or month or quarter. But if you look over 5, 10, and certainly 20 years, they move basically in lockstep. And so that's really the key, is knowing that if you can predict intrinsic value, then, and you give yourself, let's say 10 or 20 years, you know that a stock price is also going to go up over, alongside that intrinsic value. And intrinsic value, I think, is easier to predict than any given day's stock price, because the stock price is influenced by people, and people are, emotional and fickle and, impossible to predict in the short term. But we do know that over very long periods of time, that price basically has to follow the intrinsic value, even if any day, given day, it doesn't necessarily have to. So I think that's mainly our approach. It's basically follow the cash flow. If the cash flow is there over long periods of time, the stock price will follow.
This reminds me of, when I first learned about returns on equity, and I thought, well, this is really a return on book value, but this wonderful business I want to buy trades at 4 or 5 times book value, so I'm not getting that return. And then Charlie Munger taught me, well, no, not right off the bat, not this year, you're not, but over time, they converge, they become one. So that is very similar to that's one of the things that happens over time in the way that you're describing, right? It's just keep cranking that return with 20, 30, 50% on equity, whatever it is, and over time, given that you're not reinvesting like 100%, you will get that return, that weighted return. So long term, it's tough. Is there anything else? How else can we address long term, Matt? What we've addressed. Not
when do you sell?
Yeah.
When do we sell?
When do you sell? Ever? I mean,
Yeah.
That's good.
Well, I think that, selling is super hard and not something I can claim to be a master at yet. But one thing we try to do is not tinker too much with the portfolio. So we try to be either fully in or fully out of a position, and most of the time sitting on our hands. So we try to resist that urge to, add or double down or, trim here because they had a good quarter and it's, a 16 multiple instead of a 15 and all that kind of stuff, because that goes back to our business owner mindset, right? We want to just sort of sit on our hands and do nothing and let these businesses work for us, just like if we, owned a portion of a private business. And that's, of course, much easier said than done, because you're sort of faced every day with these flashing lights on the screen and all this, drama in the newspapers and the earnings calls, and, you want to do something. There is a do something bias there. But I think that you're, investor, if you do the job of getting into a really good business, if you own cigar butts, then maybe you do have to be more opportunistic and trade around a position. But when you buy really good businesses, you are, best just to sit on your hands. And so, that's what we try to do. And we try to say, we look for no-brainer decisions, right? That's what Buffett and Munger talk about. And so if something's trading at, let's say, 5 to 10 times free cash flow, well, that seems pretty cheap. And we'll do our forward return analysis and look at intrinsic value in 5 years. And we'll compare that to our opportunity costs. And if it's sort of in our top 10 or better, or if it's, looking kind of a mid-teens or higher forward return, we'll probably buy it. And at the same time, then if that stock appreciates a lot, and so it used to be for me like 20 times earnings, but now I've learned to let them run a little bit more. So let's call it 30 times earnings or something thereabouts. Then you want to start, you'll naturally be updating your forward returns, and your yield component will naturally have come down a lot, even if they're paying out a lot, a 100% payout of earnings at a 30 times multiple is going to be about a 3% yield. So you really would be counting on a substantial amount of growth to get competitive forward returns at that point. And so at that point, such a stock would probably fall down on our opportunity cost list, where we'd probably have better ways to deploy the capital. So when we look at our opportunity costs, we're not trying to split hairs and say, well, this is a 13% forward return and that's a 14, or this is a 15 and that was a 12. We're looking for, like this is an 8 and that's a 20. Things that are really no-brainers. They should jump out at you. We are not, living in Excel. These are more, sort of back of the envelope sort of things. Math, when you're reading a 10K, you're rounding the numbers and doing the math in your head, and it's still screaming out that, oh, this is either very cheap or this is quite expensive.
Right. Ballparks. Those numbers are ballparks.
Mm-hmm.
Yep.
Absolutely.
Yeah, that was that. Yet another. I keep talking about the things that I learned from Buffett. That was another one. You don't. It's you can't pinpoint it, because I started out, when I first started with all of this many years ago, almost 30 years ago, I guess. Um, I tried to do the same thing everybody tries to do in the beginning. Like, you look at price charts, right? Availability bias. That's what's of it. That's the data point that's in your face.
Hmm.
So that must be the most important thing, right? so you look at that and you're like, you want to pinpoint. How do you know to absolutely buy it here? You know, with 100% certainty it's going to go up, that sort of thing. And then Buffett's like, well,
Absolutely.
not only can't you do that, but you can't really know what your return's going to be. So, even if you do all this fundamental work, so just chill out. Um,
Yeah.
it's an important point, because it's about how you spend your time, right? Are you wasting a lot of time on that type of unachievable precision or not? So yeah, the long-term orientation. Um, I guess I think that it's more important than ever, because the way that most people get at this, if they do it at all in their real lives, is through their 401ks, but they're buying S&P 500 funds. So right now they're putting close to 40% of their money into a group of stocks that everybody on earth is convinced are like the new Nifty 50. You can't go wrong. They're absolute no-brainers. And we know over time that this sort of, what research affiliates calls top dog phenomenon, the regime changes and they perform poorly compared to the S&P 490. Since I saw one set of data since the 1950s, they've learned that. But so the long-term orientation is necessary, and it's necessary to get you away from this effect that has really, to me, I think people's S&P 500 portfolios are going to go sideways for 10 years, is what I'm afraid. So what pond is there? A pond? Are you all cap? Are you, anything from 10 million market cap to 100 billion? Do you care about market cap? You say you care about industries, like you don't go for the cyclicals. um, but how would you describe your pond, your universe?
Yeah, so we will go anywhere we think we can understand, which we try to be, humble and know is probably not as large as we think it is even. But so yeah, we'll go, international, but we'll tend to stick to,
That's very humble, Matt. Wait a
like the
minute. Wait a minute.
UK or
I can't
Canada.
let that go by. It's probably not as big as we think it is. That's a very humble statement. But I'm sorry. So you continue, please. Sorry.
Yeah, yeah. So we yeah, and we've been humbled in the past, so that's how we know, all
There you
right?
go. Yeah, it helps.
Me
But
too.
but yeah, so we'll go international and we'll go small cap to large cap. We tend to you like those businesses in replication mode that have proven economics. So we don't usually go too small because those tend to be, sort of at the beginning of proving themselves out. So I would say, yeah, like mid and large cap is typically where we're gonna hunt, but we don't really pay attention to market cap when we're looking at businesses. It's we have businesses that are $1 billion market cap and we have ones that are 100 billion. So industry wise, we we tend to prefer non-cyclicals. It doesn't mean that's exclusively what we invest in, but we think those are the easiest. It's kind of like turning it into an equity bond, right? If you can sort of just understand and know that there's not a big normalization you have to do for major cycles. We like businesses that aren't subject to a lot of external factors that aren't under their control. So again, none of these are like hard and fast rules. They're more guidelines, but we tend to, we like companies that can control their pricing, for instance, like ExxonMobil, great company, but they don't know where they're going to be able to sell oil in 5 years from now or next year for sure. And so that's just, it makes it a little bit more difficult for them. Versus like a See's Candy, they know they can raise the price in 5 years or 10% and next year, and people are going to keep buying it. So it's just an easier business to understand. And that's keeping it simple is really one of our kind of core tenets. We like to diversify our portfolio by risk factors. So typically that would be an industry, but not necessarily. So you could have, like we owned Alimentation Couche-Tard. We no longer own it, but they own Circle K, the gas station. And that, in a sense, could be exposed to EVs. And similarly, like AutoZone could also be exposed to EVs. So even though they're not really in the same industry, they have a same risk factor. So we want to sort of make sure that we don't end up having, 10 stocks that are all exposed to, one of the same risk factors. So we'll typically try to limit it to like 20% of the portfolio in any one risk factor, and that kind of spreads it around. We like to diversify by like income or like consumer type and consumer income. So we like to have some international consumers, some domestic. We like to have low end consumers as our end market. We also like to have at the same time high income consumers as our end market because they will often experience a business cycle differently. So that's all sort of a way to try to balance out some of the volatility. And ultimately, we think that if we can manage, to have a relatively low volatility of our portfolio's underlying cash flows, that there's a chance that the overall volatility of the stock prices sort of matches that to a degree. And one of the benefits, or what we hope to be one of the benefits, is if you own enough non-cyclical businesses, when there is a deep drawdown, maybe one or two of those, the stock price actually holds up. And then it's an attractive business to sell, to buy something cyclical at a very deep discount. So we sort of got a chance to do that during, March 2020, during COVID. There's no guarantee those, stock prices will hold up, but you think if you own a couple non-cyclicals, maybe one of them does.
Every time you say non-cyclical, I always want to say, how non-cyclical are we really talking about? Because, those share prices go up and down too, don't they? And, the results aren't a perfect straight line up and to the right forever either, right? There are, in other words, there are cyclical influences, right? Even when
Absolutely. Yeah.
Yeah, there's one.
Yeah. Oh, go ahead.
There's one that as you were explaining that, just came to my mind. In 2022, Hershey's was up in a big returner, and then since then, since about 2023, it's been down. I don't know how much now, but a lot, with like talking about cyclical, like talking about cocoa prices and competition and those sorts of things. Like that was just one example that came to mind as you were describing it.
Yeah, so I think there is going to always be cyclicality of a stock price, at least to a degree, but we try to look at underlying cash flow cyclicality. So I think Hershey, I don't know off the top of my head, but their cash flows have not been that impaired by cocoa prices going up dramatically, right? They were able to hedge some of it. I think those hedges are now wearing off, but more that stock has come down because it was trading at a pretty growthy multiple, and now they're projecting some margin compression and maybe less growth. It's probably an overreaction to a degree, as the market tends to do on both sides. So the stock is probably going to be much more volatile than the underlying cash flows. Even the most stable business will experience some volatility in its cash flows, which is why you do have to diversify. But yeah, if you look at something like DaVita Dialysis, I mean, there were so many fears about GLP-1s. There was the Supreme Court ruling that people were worried about. None of that ended up making a difference in their cash flows. But the stock, still went up and down 50% a couple times in a few years. Yeah. So, we look for like when we talk about non-cyclicals, we're really talking about those underlying cash flows. If you think about like a royalty type business, those are great because you're taking sort of a fixed percentage of a certain amount of throughput, whether that's like Visa or like Brookfield is an alternative asset manager that earns management fees, and that sort of has royalty characteristics. So royalties tend to be, not have a lot of, not a big cost structure. And so, there's kind of a stable throughput and a stable margin on that. And so, yeah, there's some volatility, but it's relatively non-cyclical, relatively predictable compared to a lot of industries, we think.
Right. You're just describing a real focus on exactly what you've said you are, on the business, right? You're focused on the cyclicality of the fundamentals, the financial results, the financial condition, the demand for the product, et cetera, et cetera. And I think we're getting to an answer from my earlier question. This is how you do long term. You you maybe, for great periods of time, you can be mindless about it in your 401k, but maybe not always. And learning some of what you've taught us is really important. When you mentioned GLP-1s, I'm sorry, I chuckled. But like, I'm still waiting for United Airlines to say, yeah, we're saving money on jet fuel because the passengers weigh 30,000 pounds less. You know what I'm saying? Like,
that one never ended up.
These effects have been, strongly touted, but we're all kind of, we're waiting for them to happen. We'll see. Did you buy any of the pharmas, like, 5 years ago when however long ago people first started talking about this? Or they're not simple, are they?
I wish. No, I mean, I think those, maybe there's a case to, buy a basket of them or something. I think that I wouldn't be able to predict, any given, breakthrough or anything like that. One business we own for a long time and we like is McKesson, which, we bought it well before GLP-1s were on our radar, but they've ended up benefiting as a distributor of those. But we think that's like a better place to be in the pharma supply chain, or at least like, it's a little bit simpler place to be, just moving the medicine from A to B.
Right. Let's see. I think we have reached time for our final question. And I have to say, I could do this with you, Matt, for a long time. I don't say that to every guest because it's a lot of fun. And I enjoyed meeting you in Vail, Colorado this summer, and I really enjoyed this conversation. I'm enjoying your Substack and your website and everything else. So the final question is the same thing for every guest, no matter what the topic. If you've already said the answer, by all means, feel free to repeat it. But the final question is just simply, if you could leave our listener with a single thought today, what would you like that to be?
Yeah, I'll leave you with one of my favorite quotes from Ben Graham, the father of value investing. And he wrote in The Intelligent Investor, he said, investing is most intelligent when it is most businesslike. And I think that that is a really good idea to dwell on and really take that business owner mentality to your investments. And I think that means, removing a lot of the nonsense, the emotions, the day-to-day drama of the markets. And, we often tell investors, like, if you were going to go invest in a duplex or, a rental property, you would, you'd sort of look at the competitive advantage of the location. Is it going to be in a place where people want to live or visit? And, are the schools good? Is crime going down? And then you would say, what does it cost to maintain this? What's the insurance? Do I need a new roof? And you'd sort of back into what can I charge on rents? And, you back into a yield, and maybe you bake in a little bit of capital appreciation, and that would be your return. And it's something I think almost everyone intuitively knows how to do, but they sort of forget that and throw it out the window when they're looking at stocks, which are also just businesses, and the same sort of analysis and reasoning should apply. So I think being businesslike when you evaluate a stock is the key to being successful.
Well put. I'm going to pile on and tell people that comes from chapter 20 of The Intelligent Investor. And read and reread chapter 20. Read it once a week. Read it once a month. I used to have a little reminder on my phone to read it once a month. I just think it's that important. That's one of the quotes there. And he's got, business principles in there, a little list of the business-like principle. It's a wonderful, wonderful short little thing that I think has the power to change your life as an investor and make you more long-term, like Matt and Eagle Point Capital. So listen, thanks for that.
I'm going to do that.
Yeah, do it. Yeah.
All right.
Thanks for being here, Matt. Enjoyed it immensely, and hope to have you back real soon. Maybe we'll get your partner on here with you too.
Absolutely. That'd be fantastic. Thanks so much for having me, Dan and Corey. It was great to do this. A lot of fun.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.